Jimosophy, interpreting events to build wealth.
Hi, it's Jim at Jimosophy.com. Today we're going to look at inflation and its impact on real estate. So let's just start with you have a job, you earn money, and you spend money on goods and services. And hopefully you have a budget, so you've calculated what your spending is, you know your income, you can control your spending, what you spend your money on. You can't necessarily control your income. Your employer might have a say in that. They could raise it, lower it, or lay you off, or you could lose your job because of a pandemic. But you do control your budget, the spending. If you spend more than you earn, then you're going to have a deficit and you're going to have to borrow money. If no one will lend you money and you have high borrowing outstanding, you're in trouble. You may ultimately become insolvent. But so you make this money, let's first, for example, $80,000 a year, and you have this unique opportunity through credit to make a claim against your future income today. So for instance, you could buy a $500,000 investment property, which you're going to have to pay back, even though you don't have the income today. You're going to have to pay it back in the future. So you're going to really have to tailor your spending, perhaps for the next 25 years or longer, to pay back that loan. Your budget's going to be critical. So we spend on goods and services, and quite often we will use credit to buy financial assets. Financial assets like real estate, like stocks, like gold, commodities. And we use credit quite often to do that. Now, inflation, if we have inflation, it's simply rising prices. Deflation is falling prices. Now, what it does, the government keeps track of it through the Consumer Price Index, and they measure a basket of a few thousand items that the typical consumer purchases, goods and services. But what they don't include in inflation is if gold goes up 400%, which it did over the past 20 years. If stocks go up 400%, which they did over the past 13 years. Or if real estate goes up in certain markets, for example, Toronto or Vancouver, 400% over the past 20 years. That's not included in inflation. If it was, inflation would probably be 10% per year, not in the 1 to 3% range. And if inflation was in the 10% range, then interest rates would have gone way up, probably to 10%, and there wouldn't have been these bubbles. They would have flattened or went down. But that's the way they keep track of it. If you check into it, they do take a small component of rent, or even when you own real estate, about 16%. It's a very complicated formula. It's national, right? And real estate is local. It depends on the market. Buffalo is totally different than Toronto. So inflation is a flawed measure. You know, if it could take into account accurately these financial assets, which you are borrowing money to buy, or you actually have the money in your income you've saved to buy, inflation, if they had that, it would be substantially higher, so would interest rates, and we wouldn't have these bubbles. Right? So that's one thing we want to look at. How do they do that? The central banks of the world generally keep a 1 to 3% inflation operating band. They like to keep inflation running in the middle, around 2%. If inflation value of goods and services goes up above 3%, automatically the central banks, the Federal Reserve in the US, the European Central Bank, or the Bank of Canada, would increase interest rates. As soon as they increase interest rates, consumption would slow and inflation, rising prices, would fall back into the 1 to 3% range. If, for instance, prices drop below 1%, the central banks of the world will automatically decrease interest rates. When they decrease interest rates, consumption will increase, and so will inflation. Prices will rise, and they'll get back in the band. And that's the game they've been playing for years and years and years. Unfortunately, what happened with interest rates, they're zero. So it's right out of the band, and you can't decrease interest rates below zero. you're not going to pay people to take money. So at zero interest rates, think of it, if you could borrow for free, you could buy all the financial assets in the world. And no wonder they're going up. Remember the claims that you make on future income. You would pay it with your wages, your income. And if we look at real wages adjusted for the inflation that they're wrongfully reporting, it's been flat for 50 years. So, you basically make about the same inflation adjusted as you did 50 years ago. Why is that? There's a few key factors that have really come into play. Probably the biggest one is globalization. We see the world, you can outsource a manufacturing job to, say, China at a much lower wage. You could actually outsource services too with the information economy. We're just seeing more and more of that. So that's bad news for people in industrialized countries, OECD countries. That's good news for people in low wage countries. And we've seen that taking place, and there's no reason for that not to continue. Massive technological change and globalization. That's why incomes are flat. But incomes are what you use to pay your debt down. And of course, debts are soaring. So that's inflation. That's how that works. Let's look at its impact let's focus on real estate. Why? Real estate's local. It depends which market we're talking about, anywhere in the world. Stocks are not. People buy into the S&P 500, the US, they're basically multinational, gigantic corporations that operate around the world, and they're a good proxy because they are located physically or virtually in every country. And of course here we have gold. So let's focus on real estate, which again is local. So if we look at real estate, the real estate game, what an interesting game. But it's like any investment. You hope you can sell your investment for more than you paid for it, and you would really like to draw income off the investment. So I have my cake and I can eat it. My cake keeps getting bigger, I can sell it for more, and my cake keeps throwing off food that I can eat every 3 months if it's a dividend, every month if it's rent, every 6 months if it's interest. That's the game. So in real estate, we have seen house prices in Canada basically unabated rising in the neighborhood of 400% over 20 years. Of course, in the United States, they had a major correction in 2008 with the subprime crisis, which probably will be the exact same in Canada with COVID now. So we have rising house prices. Great if you own one. 60% of people own one. 40% of people either rent. So there's investors that own properties and they rent them because 33% of people rent. And there's also vacant rental units. So you have people that live in their own property. They're happy and that's what they own. And you also have investors, about 40%, that buy to rent to people and produce income. Of course, if you add these two together, so you hope your house price goes up, and here's your cash here, and this is, if you look at a previous Jimosophy YouTube, the greatest formula ever, you'll see this formula, because you use it for anything, basically return on investment, and you can make any financial decision. This is the first thing you look at. So what's in it for me is the rental income. How much does it cost me? Is the carrying costs, in this case, of real estate. Principal, interest, taxes, heating, maintenance. You'd add all that up and just put the rental income over top, multiply by 100, and you see your return on investment. If I was to, say, buy a property in Buffalo, I would find that when I do my rental income over my carrying costs, I would have a return on investment here of around 15%. Now, if I did this in Toronto or Vancouver, it would be negative. Negative. That should tell you something. why would you want to invest in something where you lose money every month? Well, again, you might think you can sell it for more money, even though you're losing money every month. Probably not the investment you want to make, but it is possible. Here we have interest rates. Interest rates have dropped since 1981 to today, almost 40 years, straight down from 21% to zero. And not surprisingly, consumer debt has soared as the cost of borrowing drops. Remember we talked about credit? So in Canada in particular, they're the most indebted people in the world, owing 179% of their income, which we'll see is a real drain on their purchasing power. So if the real estate market, two things we have to take into account: supply and demand. Supply is the inventory that's available. Obviously, if inventory is tight, it's not available, it's scarce, the price should go up, all things being equal. If there's lots of real estate coming on the market, it might take a year, might take 2 years for a condominium to come on the market, and there's no demand, prices would fall. On the demand side, there's also lots of variables here. So we have interest rates, which are low, so no wonder real estate's rising. We also have migration or immigration. If people are leaving the country, that's not a good sign. If they're coming in, that's a good sign. And you could also see a Jimosophy YouTube video on immigration, because that's a critical part of demand. With COVID, it's really fallen. That's not good for demand. Incomes are absolutely critical, and we just talked about incomes. They're flat. They're not increasing. You know, we have the globalization and technological trends that are going to put downward pressure on incomes for years and years and years in OECD countries. Good for non-OECD countries, bad for OECD countries. So we have incomes that are flat, they're not rising. That's bad for real estate. And we also have personal debt levels soaring. It's almost like you hit a point where you owe so much, they just won't lend you anymore. And they certainly won't if your collateral starts to drop. So we have a negative on personal debts, very negative. We have a negative on incomes. We have a huge negative on immigration. Interest rates are still zero if they'll lend to you. And we have supply in particular markets, Canadian markets like Toronto and Vancouver, a large coming online. So that's where we are. Let's throw in currently that 20% of people are not paying their mortgages, but they come due in October 2020. About 500,000 mortgages come due in October 2020. So it's the day of reckoning. You need to pay the money back. Well, I don't have a job. This is not good. You're going to see probably in 2021, because it takes 90 days, sometimes 180 days, for the power of sale and the foreclosures to start. Needless to say, real estate will fall. And it might fall a heck of a lot in Canada in particular. If you look at the US subprime, you had a lot of markets very similar to Toronto and Vancouver dropping 50 to 60, sometimes 70% in less than 18 months. So it could take 20, 30 years for house prices to rise, but they'll correct very quick. And in a panic, it's straight down. So we have 20% deferrals, and we also have 20% of people not paying their rent. Of course, the guy who's not paying his rent can't pay the real estate investor, the owner, the rent, and of course the real estate investor / owner isn't paying the mortgage. So that all comes to, it'll be interesting to see. There'll be a lot of business for bank trustees in bankruptcy, a lot of renegotiation between lenders and borrowers, and a lot of pain, unfortunately. So I wish I had a better message. Well, actually, maybe I do. Look for markets that are positive cash flows. They're out there. They're all over the world, right? And house prices should rise when they're undervalued. Thanks for listening.
Jimosophy, interpreting events to build wealth.